It is Wednesday, January 22nd, 2020. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we will pass over some of them quickly but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing in certain charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. This month, I'd like to highlight what we see to be some of the important emerging investment themes for the 2020s. As such, I would like to cover the subjects shown here. If you found QE, QQE, and key litro monetary policies as extreme, you haven't seen anything compared to what we expect will likely unfold in the 20s. Policy extremes will continue in monetary policy with various forms of modern monetary theory, such as MMT or helicopter money, expansion of QE to include corporate bonds as currently done by the ECB, expansion of QE in the acquisition of equities versus treasury bills, notes, bonds, and mortgage-backed securities, and various forms of collateral guarantee facilities not yet practiced by the Federal Reserve in the United States. Expect to see the dramatic expansion of fiscal stimulus spending to include major expenditures in fiscal infrastructure, cybersecurity infrastructure, student loan forgiveness, public and private pension bailouts in the future. Public policy changes, expect those to fund things such as existing entitlement programs and broaden to include universal basic income. All of these policies stemming from unsound money and the slowing rate of real economic growth will continue to destabilize the existing economic financial system. In an attempt to accommodate radical policy extremes, we can expect major changes in existing constitutional and civil laws to give governments more power and control over public behavior and civil reaction to policy changes. Regulations will be expanded to control the banking and financial sectors. Adjustments to policy extremes. Taxation will increase on personal income tax, sales tax, property tax, inheritance tax, IRA, Roth, and RRSP, etc., withdrawal taxes, tax rates on pensions, all will definitely be rising in the 20s. However, taxation will increasingly even come in other forms. That is, more fees and tolls on public services, licensing requirements, levies for special programs, etc. Money must be raised as the fiscal deficit continues to explode. 50 years ago, an international team of researchers was commissioned by the Club of Rome to build a computer simulation of exponential economic and population growth on a finite planet. Few reports have generated as much debate as it did at that time, and discussion and disagreement. It is hard to argue that forecasts made back in the early 1970s haven't actually proved eerily accurate over the ensuing decades, but most of its warnings have been largely ignored by policymakers, hoping blindly for a rosier future. One of the original 17 researchers involved in the study, called The Limits to Growth, Dennis Meadows, recently revisited that study and concluded, and I quote him, "Decline is now inevitable. We're without any question moving into the remainder of a century which is going to see, by the end of this decade, a much smaller population, much lower levels of energy and material consumption, and so forth. Whether we retain equity amongst people and avoid the more violent forms of conflict remains to be seen, but sustainable development is no longer an option." End of quote. Our 2020 thesis, called Global Conflict, supports Meadows' concerns about conflict. Increasingly, demographic research supports these projections. I refer you to Chris Hamilton's extensive demographic research at the Economica blog. Renowned cycle expert Harry Dent has developed numerous demographic, economic, political, social, and other cycles, all of which are pointing to significantly increasing levels of turmoil into the 2020s. Something serious is brewing which we all can sense. The only thing we are uncertain about is what will be the catalyst that triggers it and, of course, when. Our thesis, Global Crisis, has pointed us in the direction of investment focus areas to be defense, both low intensity and hard weapons providers, portfolio protection, that is a shift to value commodities and hard and soft assets, reduce leverage and risk such as plays in the area of credit contraction, sovereign treasuries, and forthcoming fiat currency failures over the next decade. The subscriber SII section of the MATA SII site focuses on the sectors and potential 150 plus securities we currently follow and chart. What is critically important, and as important as the investment areas themselves, is the timing in the short, intermediate, and long term. Prime investment areas will go through significant transitional shifts is our conclusion from the thesis paper, where investors need to be on the right side of the current trend, even though they may have identified the right sectors to be invested in. Timing is going to be paramount. Timing will require careful integration of technical analysis and macro developments as the shift in trend continues to happen. We feel the future of the U.S. dollar will play a central role in developing any such strategies. Never forget that wealth can only be created by mining it, growing it, and building it. It can't be created by printing it or printing more money. Money is only a claim on wealth, and it is itself only a promissory note. Today, this fact is unimportant as long as money is freely exchanged and is valued as such. However, if the public stops believing in the value of money, then everything changes. Money depends on public confidence. Historically, this has proven fragile in times of uncertainty. History shows us that fiat currencies themselves, which this is based on, have never lasted. This is why hard assets, as represented by commodities, normally do well during eras of uncertainty. Primarily, wealth is represented by finite resources. Many primary and secondary wealth resources are used in infrastructure. Enduring infrastructure can additionally increase overall economic productivity if applied judiciously. Commodities are at historic lows. Additionally, spending on infrastructure in most developed economies is also at long-term lows, as many 50 to 60-year useful life projects have been bridged. That is, bridges, canals, dikes, aqueducts, etc. are long past their useful life, as well as high-speed railroad construction and newer airports, highways, etc. haven't been built to handle expanded capacity. The current trend for large funds and high net worth investors is to move out of public markets. There is a global capital swing of about 5% already underway. Finding a place to invest capital is the biggest problem for wealth investors and fund managers, as expressed at Davos last week, who are attending the World Economic Forum. They are buying infrastructure, be it real estate, student accommodation, airports. All of these asset classes are where the money is now going. What we see in this chart is that the following assets are missing from top performing sectors over the last 2 decades. Commodities, hard assets, precious metals, not showing. The red arrow illustrates this point. The 30-year commodity cycle, which has been distorted due to easy money, is likely to resume as the current monetary malpractice of quantitative easing is found wanting. The black dotted line suggested by Harry Dent is probably likely ahead in some form. Even if equities don't fall and are artificially held up by various central bank facilities, which we expect, we should see commodities soon end their long investor drought. The problem will be that bringing new commodity resources online is expensive and takes time. Even minor portfolio shifts into commodities will create outsized investment returns because of low valuations, shortages, and the small size of the existing investment pool. We are already seeing movement in strategic commodities like copper, precious metals, and soft commodities like foodstuff. Institutions are increasingly moving from overpriced public markets to private markets to find value. To do this, they are sacrificing liquidity that's available theoretically in public markets, unless there's a crisis, for that of reduced risk by buying private markets that don't have the same amount of liquidity. A trade-off, which the meteoric rise in passive fund investing has given additional momentum to, and concerns about the public markets. Like commodities, we are increasingly seeing early signs of a shift away from growth to value. The halfway measure is quality, which is on the rise as value begins a tick up. The equity story of the last decade has been the re-rating of the quality factor barely mentioned prior to the financial crisis. In retrospect, this divergence probably should not be a surprise, as the valuation discrepancy is in line with the drop in global economic activity, with the valuation gap tracking global PMIs lower. Add to this valuation risk if economic sentiment improves, and one may reasonably ask why value has only dropped this much. Like commodities, it has been a long drought in investor interest. When sectors get out of favor, like this, for such a protracted period, they often spike quickly when investor sentiment and interest finally shifts. The debt supercycle has distorted markets, with the mispricing of risk and the lack of price discovery brought on by easy money. It may be the case that commodities are in fact the biggest investment casualties. The distortion must sooner or later be corrected, and as such this may potentially be a violent correction. Never confuse price with value. Price is what you pay. Value is what you get. Because something has a high price doesn't mean it has value. Conversely, because something is priced low doesn't mean that its value is correctly assessed. The tell of a coming shift is that central banks are now buyers of precious metals. They were major sellers and leasers of gold in the 90's and early part of the century. Leases where the gold has been consumed, has actually disappeared, and must eventually be replaced because it was only taken out on lease. Gold flows have been on the rise together with increasing global uncertainty. As a result, gold, silver, and palladium have risen noticeably. What is easily forgotten is that negative real interest rates make gold attractive. With 17 trillion in negative global bonds, it is not surprising that gold and precious metals are seeing some strong interest. In closing, remember, never confuse price with value. Just because something has a high price doesn't mean it has good value. The 20's is going to be about this assessment and the preservation and safety of capital. As the famous comedian of the 30's and 40's, Joey Brown, once quipped, it isn't as much about return on capital as about the return of capital. This is going to be central in the 20's in any strategy that we or you put together. As always, I remind you, remember the answer will be, in the short term and the intermediate term, to print more money. It is the only answer politicians will actually ever agree on, until, that is, no one wants it or trusts it. Invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2020 turn out to be an outstanding investment year for you and your family, and I thank you for listening.